Welcome to today's tutorial. I will be solving ACCA March-June 2017 question 4. This should be question 4. And the question is on bond valuation. Total is a listed company in the building industry which specializes in construction of large commercial and residential developments. TICO had been profitable for many years, but has just incurred major losses on the last two developments, which it has completed in its home country, Ireland. These developments were out of town retail center and a major residential development. TICO's director have blamed the poor result primarily on the recent recession in Ireland, although demand for the residential developments also appears to have been adversely affected by it being located in an area which has suffered serious flooding over the last 2 years. As a result of returns from these two major developments being much lower than expected. TICO has had to finance current work in progress by a significant greater amount of debt finance, given its higher gearing and most other construction companies. Sorry, let me take that again. Given it higher gearing than most other construction companies operating in Ireland. TikTok director have recently been alarmed by a major credit agency's decision to downgrade TICO's credit rating from AA to BB. So AA to BB. The director are very concerned about the impact this will have on the valuation of TICO's bond and the future cost of debts. The following information can be used to assess the consequences of the changes in TICO's credit rating. TICO has issued 8% bond, which has a face or nominal value of $100, sorry, and a premium of 2% on redemption in 3 years' time. So let's break this down. 8% bond. So this 8% here is the coupon on the bond. The nominal value of the bond is $100. That means the interest rate will be $8 annually. And the bond will be redeemed at a premium of 2%, which is 102% times 100, which will be, why am I using the Naira, which will be $102 at redemption in 3 years' time. So the duration is here is also 3 years' time. The coupon on the bond is payable on annual basis, which is this $8 is payable on annual basis for 3 years. The government of Ireland has 3 bonds in issue. The government has 3 bonds in issue, and remember that government bonds are always risk-free. So this will be risk-free. They have all face value, nominal value of $100 and are all redeemable at par. Okay. Taxation can be ignored on the bond. they are of the same risk class. So for you to, I will explain this later. They are of the same risk class. And the coupon on each is payable on an annual basis. Detail of the bonds are as follows. So let's look at the detail of the bonds. So anytime you have a question coming after this manner, definitely you know that you will need to calculate the yield curve. So this is the detail on the bond. Bond one is a 1-year bond. Coupon on that bond is 9%. Year two is 7-year bond. Coupon is 7% and 6% for the 3-year bond. So this is the government's yield. This is the government bond, rather. This is a government bond. Credit spread on credit spread published by the credit agency are as follows. So these are in basis points. So remember, okay, let me just take this first. This is credit rating for AA bond, and this is credit rating for BB bonds. Total co-shareholder base can be divided broadly into two. The shareholder base can be divided into two. The majority of the shareholders are comfortable with investing in a company where dividends in some years will be high, but there will be low or no dividend in other years because of the cash demand facing the business. However, minority of the shareholders would like TICO to achieve at least a minimum dividend each year and are concerned about the company undertaking investments which they regard as speculative. Shareholders from both groups have expressed some concern to the board about the impacts of the fall in credit rating in their investments required. So basically, in your exam situation, the first thing you want to look at is your requirements before you jump into the question. That by the time you look at the requirements, you already have a little idea of what your examiner wants you to calculate. So calculate the valuation and the YTM of TICO's $100 bond under its old and new credit rating. So, bond value. How do you arrive at the bond value? The bond value is always your interest, the nominal interest, and the redemption value, all discounted at either the lender's required rate of return or discounted using the yield curve, where the lender's required rate of return is not given. So that is the way to calculate the bond value. Then the second requirement is the YTM, the yield to maturity. How do you calculate the yield to maturity? So the yield to maturity, you are looking at the outflows. And also you are looking at the inflows. The outflow here is always the market value of the bond. So the very first requirement is to calculate the bond valuation, which is the market value of the bond. So that will be an outflow to the investor in year zero because they will be buying the bond, and that will be an outflow to the investor. Inflow will be the interest for the period, it is 3, 4, 5 years as the case may be, plus the principal repayment, the redemption value of the bond. So that will be the that this is the way the IRR will be calculated. So back to the question, there's need to calculate the value of the bond. And what we need to calculate the value of the bond, we need the coupon. So when we giving the coupon on the bond, we need to check if we were actually giving the coupon on the bond. So back to the question. Now, this information here relates to the government's bond, the government of Ireland. So let's go back a little bit. Let's go back a little bit. So Total has issued 8% bond, which are, so this information here relates to TCO's bond, 8% bond, which has a face or nominal value of 100, and it will be redeemed at a premium of 2%. So it means that TCO's bond will be redeemed at 102, the interest is 8, and the nominal value is 100. So with this, can I calculate the bond value? Can I calculate the bond value with this information? No, something is missing. This cash flow needs to be discounted. I know that the annual interest is $8. Redemption value will be at a premium of $102. So I've known my cash flow, and I know that the bond duration will be 3 years. The cash flow is known, but the discount factor is not known. So how do I how do I calculate the discount factor if not given? So in this question, it will be calculated using the government bond. In some question, your examiner will give you the government yield curve. But in this question, we weren't given the government yield curve. If you were given the government yield curve, what you need to do is to pick that government yield curve and add the spread that relates to TCO to the government yield curve. Then you arrive at the yield curve for TCO. But in this question, we weren't given the government yield curve. Therefore, we will need to construct the government yield curve using bond 1, bond 2, and bond 3. Let's quickly do that. So the yield curve for the first year, these are the information for bond 1. Coupon is 9%, market value is 104. So let me do the calculation here. Bond 1. So the market value of the bond is equal to the annual interest plus redemption value all over 1 plus R. In this case, the market value was given to be 104. Therefore, 104 will be equal to annual interest is 9%. and it will be redeemed at a premium of, sorry, let me go back to that. Let me take this off. Let's go back to the question. Let's go back to the question. So annual interest is 9%. The market value is 102. So need to check the redemption. The government has 3 bonds. They all have face value of 100. They all have face value of 100 and will be redeemed at par. Okay. All of the bonds will be redeemed at par. Let me use my notes to solve this. So bond one, let's look at the variable for bond one. Bond one. From the formula, market value is equal to the interest payments plus redemption value all over 1 plus R. In this question, the market value is 104. It's equal to annual interest is 9 naira, and it will be redeemed at par. That's 109 all over 1 plus R. Cross multiply. This is 1 plus R equal to 109 all over 104. If you divide that, you have R equal to 1.0481 minus 1. Therefore, R will be equal to 0.0481 or 4.81%. That's for bond A. Let's look at the information for bond 2, this bond 1. Bond 2, the information for bond 2. Bond 2 has a coupon rate of 7%, and the market value is 102. Therefore, for bond 2, you will have your market value, which is 102 equal, you have the first year interest 7 all over. You've calculated the yield curve for year 1 to be 4.81 plus, since it's a 2-year bond, at the end of the second year, the investor will receive 100 plus 7 naira interest, which will be 107 all over 1 plus R raised to power 2. So let's solve this. So we have 102, we have 7 naira, and we have 107. So the discount factor for year one is 4.81%. Now bond B, the second bond two. So that will be the market value for bond two is 102 equal, and the coupon rate is 7 naira. So 7 all over the first year we have 0, sorry, 1 plus R, that will be 1.0481 or 81, plus the second year will be 107 all over 1 plus R. We don't know what R is for the second year. So 102 will be equal to 7 divided by 1.0481. That gives approximately 6.68 plus 107 all over 1 plus R. Try to bring like terms together to have 102 minus 6.68 equal to 107 over 1 plus R. So therefore, this will come here while the others will go the other way. Let's see what that will give us. 102 minus 6.68. That will give 95.32 equal 107 all over 1 plus R. This is here 2, sorry, so this should be raised to power 2, raised to power 2, raised to power 2. Okay, so cross multiply 1 plus R raised to power 2 will be equal to 107 over 95.32. If we divide that, what would that give us? 107 divided by 07 divided by 95. This is 95.32. So 1 plus R will be equal to 1.1225, approximately 1.123. So take the square root of both sides. 1 plus R will therefore be equal to the square root of 1.1225. So therefore, R will be equal to, let me take this off. Therefore, R will be equal to 0.59, 0.595, or 5.95%. So the last is the third bond 3. So already we have gotten the discount factor for year one to be 4.81. Year two, the yield curve is 5.95. So what we leave here is just the one for year three. So what will be your bond value? The bond value for the third one is 98. 98 is equal to the coupon for the third bond is 6 naira. So 6/1.0481 plus second year, there'll be 6 naira interest received again, 1.059595 plus the third year will now be principal plus interest, which is 106 all over 1 plus r raised to power 3, while this will be raised to power 2, and this will be raised to power of 1. So let's see what that will give us. So 98 will be equal to 6 divided by 1.0481. That gives 5.72 approximately. 5.72 plus 6 divided by 1.0595 raised to power 2. That gives 5.35 approximately plus 106 over 1 plus r raised to power 3. So let's bring items together. 98 minus 5.72 minus 5.35 is equal 106 over 1 plus r raised to power 3. So let's see what this will give us. 98 minus 5.72 minus 5.72 minus 5.35. That gives 86.93 is equal to 106 all over 1 plus r. So these terms here So we're having 86, 106 all over 86.93. 1 plus r raised to power 3 equal to 106 all over 86.93. So take the cube root of both sides, 1 plus r. So if you take the cube root of both sides, 1 plus r is equal to the cube root of 106 all over 86.93. Therefore, 1 plus r will be equal to 1.0683. R will be equal to 1.0683 minus 1, which is equal to 6.83%. Therefore, the government yield curve will now be year 1, year 2, year 3. Year 1 will be 4.81. Year 2 will be 5.95. And year 3 will be 6.83. So this is the government yield curve. So with this government yield curve, you can go ahead to determine the yield curve for TICO by adding the spread relating to TICO's credit rating. So let's go back to the question and look at the spread relating to the credit rating. So this is the question. The company currently has double A, rating of double A. But if the bond is downgraded, it will become BB. Okay, so let's look at the spread. So for the double A, the first year is 1.8, 18, 31, and 45 basis points, 54, 69, and 86 basis points. So we need to factor in the yield curve into this calculation to know what the company's yield curve will look like under both rating. So if you don't have the question, you can pause the video and download the question. It's ACCA March, June 2017, question 4. So now let's construct the company's yield curve using the government's yield curve. We have the year 1, year 2, and year 3. So for the governments, the yield curve in percentage for year 1, 4.81. For year 2, we calculated it to be 5.95. And for year 3, 6.83. So if the company credit rating is double AA credit rating. The spread for 1 year is 18 basis points, which is 0.18, 0.31, and 0.45 under the credit rating of AA if the bonds are not downgraded. So what will be the yield curve, the expected yield curve? So this will be 4.81 plus 0.18. That will be 4.99. This will be 6.26 and 7.28. This is old. This is old rating, which is the A rating. AA rating. So under the new rating, it will now be the BB rating. The spread under the BB rating for 1 year is 0.54. For the second is 0.69 and 0.86. If this is added for the BB rating, you will have 5.35. Yeah, we have that. You're adding 0.54 to the government yield curve. The second one, 5.95 plus 0.69, which is this plus this. That will give us 6.64. And the final, this plus this, we give 7.69. The next calculation is the calculation of the bond value under each of the rating, both the old and the new rating. Let's start with the old rating. So bond value under the old rating, which is AA. So your bond value naturally is your interest plus your redemption value. Interest plus the redemption value. But now the yield curve has been given, so the interest will be discounted year after year. Year one, year two, and year three. The interest is 8 naira for the first year. Interest is 8 naira for the second year. And we're told that the bond will be redeemed at a premium of 2%, which is 102, plus interest of 8 naira. So that will be 110 the final year. So 110. And the discount factor will now be 1.0499 raised to power minus 1.0626 raised to power minus 2, and 1.0728 raised to power minus 3. So this is your discount factor. Discount factor. So your cash flow will be for the first year 7.62, for the second year 1.0626 plus 1 raised to the power minus 2 times 8, that gives 7.09. And for the third year, 110 times 1.0728 raised to the power minus 3, that gives 89.09. So the bond value 103.80. Under the old rating, the bond value will be 103.80. So under the new rating, let's see what the bond value will be under the new rating. The cash flow remains the same under the old or the new rating. 8, 8, and 1, 0, 110. This is the year. This is the amount. And this here is a discount factor. 1.0535 is to the power minus 1. 1.0664 is to the power minus 2, and 1.0769 is to the power minus 3. So your answer here will be 7.59, 7.03. This times this gives us 88.08. So the bond value is 102.70 for value. So the final requirement is to calculate the YTN for each of the bond. And in calculating your YTN, what you want to look at is the cash outflow and the cash inflows. So for the second bond, the market value of the bond is 102.7. So this is the outflow for the investor in the second year. For the first bond, this is the outflow for the investor. This is the market value of the bond. So this is the outflow for the investor in year 0. This is the outflow. Or this is the inflows. 8 naira, 8 naira, and 110 becomes the inflow. Now I want to calculate the yield to maturity for bond 1. Year 0. Take this down. Year 0. And we have the cash flow. So year 0 is the bond value 103.80. And the interest 1 to 3 is a 3-year bond, 8 naira. So you're going to pick 2 different discount rates. So let's work with 8% first. Discount factor 8%. Year 1 is still in 1. year 2, year 1 to 3, annuity year 1 to 3 with 2.577. Then the final year, year 3, principal repayments will be 102. So observe this year 3, here is not 110 as it was in this previous example. Previous example, it was 110 because when we're calculating the bond value rather, this is 8, 8, and 8 plus 102. So interest and principal was added here so that you discount it together. But here, the interest was separated year 1 to year 3. So 8 times year 1 to year 3 is already here. Then the final year, year 3, is just the redemption value. The discount factor here is 0.794. So what will be the discounted cash flow, the present value of the cash flows is remain at 103.80. 8 times 2.577 gives 20.26. 102 times 0.794. That gives 80.99. Add up, you arrive at a negative of 2.19. So since this is negative, it means that the second rate will be reduced. Negative means minus. We used 8 before, so let's bring it down to 7. The exam condition, if I'm take it down as much as you can take it down to 5, can take it down to 2, as much as you can. So discount factor, 7%. Year 1 will still remain at 1. Present value be 103.80. Annuity factor, 7%, year 1 to year 3. That will give 2.624. Year 3 discount factor at 7% will give 0.816. So 8 multiplied by this we give 20.99. 102 multiplied by this will give 83.23. When added, this will give a positive figure of 0.42. So your IRR is now equal lower rates plus higher NPV all over higher NPV minus lower NPV, higher rates minus lower rates. So times this. Well, with that, if the lower rates here is 7% plus the higher MPV is the positive MPV, which is 2.19 all over 2.19. So this is minus, 2.19 is the negative, so that's the lower MPV. So the higher MPV should be 0. Zero point 0.42. So the lower MPV is negative, which is minus. Since there's another minus here, that will change to plus. IRR will be IRR will be 7.16. IRR equal 7.16%. For the second bond, it will be calculated the same way this has been calculated. So bond 2, here, cash flow, the discount factor, and the PV of the discount factor and PV. So year 1, year 2, year 3, the cash flow for the second bond, cash flow for the second bond is 102.70. So 102.7. The interest remains at 8 naira and 102 redemption value. So the discount factor here will be 1, and the present value will be 102.7 negative. This annuity factor, so we'll still work with the same 8% here. So this is 8%, your first 8. Annuity factor, it should be 1 to 3. So annuity factor 1 to 3 will be 2.577 times 8 gives 20.62 as before. Year 3, 0.794. When multiplied, that will still give 80.99. So when added, this will give a negative 1.09. So this is negative So the second rate should be reduced 7%. It's 1, that is 102.7. Rating factor 7% for 3 years, just as we had it before, 2.624. We multiply by 8, that will give 20.99. Then the final year is 0.816. We multiply it, it's gonna give 83.23. 1.52. So the IRR simply would be the lower rates, which is 7%. So YTN equals 7% plus brackets. The IRR now is 1.52 over 1.52 plus 1.09 is minus 7. So the final answer will give, so this will be equal to 7.58. This is the theory. This is the calculation part of it. The last requirement B. So we look at requirement B before going to requirement C. What are those variables that affect credit rating of a company? Number one has to do with the gearing. So a company that is highly geared, the credit rating of the company will reduce. Just like the company's company here, when it was AA, the rating was better, but when it was BB, the rating was downgraded. So number two has to do with earnings protection. Earnings protection. This has to do with the ability of the company to generate revenue and also to cover its interest payments. So the capacity of the company to generate revenue, both in the present and in the future, will also determine the company's credit rating. The next one is industry. So the industry a company operating as a way of affecting or impacting on the company's credit rating. Like TICO is in the construction industry, and generally in the construction industry in Aram land at that point in time, by if the credit agency compares the performance of that industry, it's going to impact on TICO's credit rating. While the next is the country where the company operates. So the credit rating of the country will also impact on TICO's credit rating because TICO credit rating cannot be better than the credit rating of the country where the country of its origin.